Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Hi everyone, I would like to welcome you back to another episode of Investment Cubed. Today we have Sam Bates, a partner of Trinity Capital Group here to discuss his amazing 134-unit apartment complex in Newnan, Georgia. Mr. Bates spent 11 years in corporate America where he honed his business acumen and developed many characteristics that have helped him succeed in the real estate industry. Sam began his career at UBS Financial Services where he cultivated his knowledge about the financial markets. He directly worked with advisors that had over $3 billion in assets under management. In 2016, Sam started Trinity Capital Group with two other gentlemen. Trinity Capital is committed to developing lasting relationships with investors by providing them with exceptional customer service and wealth-building opportunities through quality real estate investments. Sam plays a vital role in many aspects of these transactions. His responsibilities include sourcing and underwriting all acquisitions and dispositions, being the liaison with attorneys, brokers, investor relations, and asset management.
I went to Texas A&M and majored in finance, and I thought I was actually going to get my master's in real estate after I graduated undergrad, but I had an internship at UBS in LA, and I went out there and loved it. And after that, I just accepted a full-time job out there. So I was an investment analyst, and I worked with a lot of high net worth individual portfolios and structuring portfolios to optimize their return. And then after a few years, I decided to get my master's. So I went back to school and got an MBA, and also I got a master's in financial planning. And when I was graduating, that's when the market crashed. And I felt like I couldn't work or help raise money for products that I don't believe in and that I have no control over. So I went into consulting, and I was in consulting for about 5 years and worked at an oil and gas company 5 years. And coterminously during that time, I started investing in real estate. I was a limited partner in the first real estate transaction I ever did. And it was a 208 unit deal in Dallas. The deal, it did well overall, but there were a lot of issues from the beginning to the end. And luckily the market had been going up. And I think that was the main reason we didn't lose money at that time. So during that process, I realized I wanted to be in control through the stock market crash. And then that limited partner experience, I realized I wanted to be in control of my destiny and my retirement. So I started investing in single family homes, and I did roughly 20 in a 3-year period. And it was either buy and hold, fix and flip. Those were the main avenues. I did one ground up development, single family home. And then in 2014, I started looking at small apartments for myself. And I ran into a colleague or an old colleague of mine that was at one of the consulting firms. And he was also investing in real estate and had a similar path, but he didn't have any experience from a multifamily side, but we were both looking at small apartments. So we decided to partner up together and raise equity for apartment deals. And at the time, that was 2014, 2015, and we were too conservative on our underwriting, but also several of the brokers we worked with told us that we didn't have a track record, we didn't have the background, we were too young, and they didn't trust that we could close. So after we got told that once or twice and couldn't get a deal through the finish line, we reached out to another guy who was a developer, and we asked if he could build an apartment complex, and he said yes. So that was kind of the first dive into multifamily. We did a mixed use 10,000 square foot retail space with an apartment complex behind it, and that venture was successful. And over the last 4 years, we've done 11 projects. Most of them are multifamily, but we did a lot development, an RV park, and then either developing apartment complexes or acquisitions of apartment complexes. And then this apartment complex acquisition is with another partner I've been working with for a while, and he's in the Atlanta market. He's also has properties in Florida and Texas, and we're really excited about it. We think it's in a great location in Atlanta, and one of his properties is 20 to 30 minutes away, kind of in the trajectory of the on the same highway, and he's done phenomenal on it, and we think that Brighton Farms is going to do just as well. Brighton Farms was built in 1972, and for being a 72 vintage, we feel like it's in really great shape. And what attracted us to it more so than just the asset itself is the location. It's split between two city roads, but in around the apartment complex, they have a lake that is a built-in amenity that's a phenomenal attraction. We're literally a stone's throw away from $500,000 to $700,000 houses, so the location's really hard to beat. And some highlights about Brighton Farms is the current ownership group. They really haven't put much capital into the asset, and we feel like if we go in and renovate the asset and bring it up from a 1970 to 1980 look to 2020 look, we can push pricing. And once we were at the site and during due diligence, there was a lot of things, and we noticed that the current property manager is doing that is either inefficient or is just not taking advantage of the market. Like they use a LRO system that basically tells the property manager what to put the rents at, and it gives them no ability to use just to think for themselves and to use foresight. Like for instance, the 2 bedrooms and 3 bedrooms only have a $5 price difference, and that was all based on what the LRO system said. Another thing is some of the buildings have built-in screen porches. Well, they aren't charging a premium for the porches when that adds on more square foot, and we could take advantage of it. They aren't aggressively pushing rents. I think the LRO system is the main reason of it. The property itself is great. It has great curb appeal, but there's a lot of trees, and we plan to go in and just remove some of the trees and just make the curb appeal look that much better. Because when we were there, granted it's November, so leaves are falling, but there was leaves everywhere on the property. And since the current ownership group or the property management company hasn't added the capital needed to have Brighton Farms reach its full potential, we feel like we can go in and add some amenities, add some different things that put it in fenced yards where people, if they have dogs or if they want their own private yard, will pay maybe a few dollars extra a month in rent, which just helps the NOI, which helps the valuation once we go to sell or once we go to refi. And it's in a very high affluent area. Median income household is anywhere from 68 to 75,000, depending on what website you look at and data you're looking at. So we feel great about the location and the potential that we can bring to the property just based off income statistics. I've been looking at Atlanta with Omar, who's the co-GP on the deal, for a year and a half now. And he already has property in Atlanta, well, a suburb of Atlanta, and Newnan is a suburb of Atlanta. It's 30 to 45 minutes southwest, depending on traffic, and people are just going, it's growing. Atlanta is one of the fastest growing cities in the nation. And obviously some people want to live outside in suburbs, or they want to live a little bit further away from the city, and they have a lot of growth in the direction southwest of the city, and Newnan follows one of those highways, and they're getting a lot of traffic and a lot of people moving there because of the suburban sprawl that's occurring. We're purchasing Brighton Farms for 16.2 million, and after due diligence, we allocated roughly 1.3 to 1.4 million dollar renovation budget, and we think this is a very healthy budget. I don't know if we'll use all of it, but it's better to be safe than sorry, and our loan allows us to roll in the renovation dollars into the loan. So we just want to be safe with the reno budget. And our IRR is, we're projecting a little bit greater than 15% IRR over a 5-year hold period. And our cash on cash return is north of 8%. And then our equity multiple, we're projecting almost doubling your money in 5 years. It's around a 1.91, 1.95, something like that. And then with the loan we have the ability to exit that loan in really anywhere from 2 to 5 years. So we've projected a 5-year hold period, but realistically we might even be selling in year 2 or year 3 once we do the renovation. Once we get that major pop in value increase, we'll either sell or we'll refi into a longer term loan and select agency debt at that time. And if we go that route, it'll have a low interest rate, I'm sure, since interest rates are low and the Fed has promised to keep rates low for the next at least 2 to 3 years. And then if we refi into agency debt, we'll hold the property for another 3-4 years and then exit at that point. Brighton Farms is a 506c offering, which means we're only accepting accredited investors, and we've done this on a couple deals in the past and it's worked out really well. And we have a minimum investment of 50,000, but we're giving preferred treatment to investors who bring 100,000 or more. And we've already started accepting PPMs. So if you would like to get into the deal, please reach out to me as soon as you can, and I would be happy to answer any questions you have.